Hey, what's going on YouTube? And welcome back to Tech Conversations. I'm your host Guillermo. It is June 17th. Hope you're all having a great day today. As you can see, it is a green day for me, up $1,200 today, or about 1.1% today so far. So we'll see what the rest of the day brings us. I will give you guys a portfolio update tomorrow as well. Now in today's video, I want to talk about a very powerful strategy, very cheap to enter and can give you some pretty big returns. So I want to talk about how we can set this strategy up and how it works. Now, before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Also, check out the Discord, link to it in the description below. 39,000 members, completely free. Or you can also become a premium member on here for $7 a month. You'll get access to a bunch of great resources. One of them is our alerts. Here's an example of an alert. This is a call debit spread on Facebook. We paid $42. We sold for $82. So we made a $40 profit, or almost a 100% return per contract on this alert. So again, check out the Discord, link to it in the description below. So let's get into this video now, guys. So let's first talk about what our goal here is with this strategy, and of course what stocks we want to be using with this strategy. So our goal here is to profit from a neutral stock price action with limited risk. Again, I avoid any strategies that have unlimited risk. I suggest you do as well. And by the way, guys, before entering any options trade, make sure that you know how to close it. Don't enter a trade without knowing how to close it. And I'll put a link in the description below to a video where I explain how you can close an options trade. And so the appropriate market forecast then for this strategy, since we're going to realize our max profit if the stock price is at one of our strike prices at expiration, the forecast should mostly be neutral, but you can basically construct this strategy to also be modestly bullish or modestly bearish. Again, it's really going to depend on the strike prices that you choose, but for the most part, I would stick to more of a neutral market forecast here. And so the ideal stocks then should be stocks that trade sideways, stocks that stay within a defined range. In other words, stocks with low volatility. And so for this video, what I want to use, I'm going to use just a random stock because, again, this is just an example. Don't copy this trade. Just to show you how this works, I'm going to use Plug Power. Now, this is definitely not the best stock to use for this strategy. Plug Power is more volatile than you'd want it to be for this strategy. But again, just to get you guys going with how this works, how the setup is, and just to show you guys an example here. So I'm going to go over to the options here for Plug Power. So here's what we're going to do. So the first thing you need to do, of course, is choose an expiration date. Now I'm going to choose June 25th just to give us enough time for the stock to, be in the range we want it to be. This expires June 18th is tomorrow, so let's go to June 25th here again just to give us enough time. So now that we've chosen our expiration date, the next thing you want to do is you want to take a look at the stock, and you want to, first of all, another thing I want to mention quickly is you want to find stocks with high liquidity, stocks that have high volume, high open interest, right? If you take a look at the options contract, you can see open interest, you can see volume. You want to stick with stocks here that have high volume, high open interest, because that makes it easier to fill your order. It'll make it easier to close out of it when you want to close the trade. So that's another thing I do want to quickly mention. But now that we've found all of this, the first thing we want to do is we want to determine what price we believe this stock will be at on the expiration date. So let's say that on the expiration date, which we chose as June 25th here, I think Plug Power will be at $29.50, or as close to that as possible. So then what I want to do is I want to find the option where the strike price is as close to that price you came up with as possible. And so there is a $29.50 strike. So I'm going to go to this option here. What I'm going to do is I'm going to sell a call here. Okay, now remember, when you sell a call option, you receive a premium. For selling this call, we're going to receive $1.17 per share. Remember, there's 100 shares in each one of these contracts. So I'm going to in each one of these contracts, I'm going to receive $117 for selling this call option here. Now what I'm going to do is I'm going to switch over to buy. Okay, so all of these will be calls, but now I'm going to switch over to buy. And what I'm going to do is I'm going to go back to the call I sold, and I'm going to go down one strike to this one right here. and I'm going to buy this call. Now, remember, when you buy an option, you have to pay the premium. So here I have to pay $1.41 per share, or about $140 for this contract. Now that I've done that, I'm going to go back to the call I sold, and I'm going to go up 2 strikes. So I'm going to go up 1, 2. And here I am at this strike, and I'm going to go ahead and buy this call option as well. So I'm going to pay 82 cents per share, or $82. Now, we need to change the amount of contracts we want here. To do that, we click on this drop down, we go to custom, and so what we want to do is for the calls that we're selling, we actually want 3 of these, and then for the lowest strike call that we bought, which is down here, we want to buy 2 of these. So I'll go down here, and we actually want to buy 2 of these. So this is what it's going to look like. So this is actually a variation to the long Christmas tree spread with calls. Looks very similar, but it's a variation. In fact, here's the one that we actually talked about the other day, which looks like this right here. Notice the graph here. Notice how it looks like. Notice the break-even points and stuff. Here's the variation. So as you can see, it basically leans over to the other side. The amount that you pay, your max profit is going to be a little bit different. Your break-even points will be a little bit different. But again, you can see the difference there. This is the one we talked about a few days ago, and this is the variation now. So that you can understand, you have 2 different scenarios here. And again, your break-evens are going to be different. How much you pay and how much you profit are going to be a little bit different as well. So understand you have 2 different scenarios here that you can utilize. So again, this is the variation to the long Christmas tree with calls. And so as you can see, this is going to cost us about $10. And so our max risk then, our max potential loss is going to be the net debit that we're paying to enter this trade minus commission fees. And I'll talk about commission fees here at the end of the video. But remember, Robinhood doesn't have any commission. So if you're on Robinhood, you don't have to worry about that. Now our max reward, our max profit is going to be 2 times the difference between the lowest strike price, which in this scenario is going to be the $29 strike, and the strike of the calls that we sold, which is $29.50. So the difference between this is 0.5 times 2 is 1. Multiply that by 100 is 100 minus, of course, the cost to enter, which is 10. So 100 minus 10 minus 11, $89, $90. So again, in this scenario, we're basically going to be risking, $9 to potentially make, or we're going to be risking about, $7, $8 to potentially make $90, $93 or so. So again, pretty low risk to higher reward. But remember, when you see situations like this, the probability of you being right on the dot, making the most profit is going to be low. So make sure that you understand that as well. But again, we can kind of look at this profit and loss chart here to see where we're going to be making money, where we'll lose money. But now that we know that, let's go over to the options profit calculator. Let's take a look at what this variation looks like then. So let's go over to the options profit calculator here. So I'm going to click on 3 legs, and let's go ahead and set up this exact same trade on here. So again, we'll go to the symbol here. So you can enter the ticker symbol for the stock. So we just used plug power. Remember, that's ticker symbol PLUG. So I'll go ahead and click in there and go PLUG. And I'll go ahead and click on get price here. So it gives me the stock price. And then we'll go ahead and we'll sell a call here. So I'm going to go to sell or write. And I'm going to go ahead and do the $29.50 call. And remember, choose the correct expiration date, which is June 25th. So we're going to go to $29.50, which is right here. And then I'll go ahead and sell 3 of these. So there is that. And then remember, we want to buy a call. Again, same expiration, calls are on the left. We bought a call at the $29 strike. Now we're doing 2 of these, remember. So we can actually change this to 2. And then we're going to go ahead and remember, we're skipping 2 strikes from the call that we sold above. So we went to the 30.50 strike. So again, same expiration date, 30.50 is right here. And we're going to go ahead and do 2 right here. So we have one. So as you can see, we're selling 3 calls here, buying 2, buying 1 here. And so let's go ahead and do the range from, let's say 28 to, I'll do 32 here. And then we'll calculate this here. Let's see what this looks like here. So again, Entry cost is going to be a debit. We're paying to enter this trade $9, which is also our max risk. So that's the most you can lose here. It's limited risk and it's defined. Max return $91. And that's going to happen at an expiration on expiration date at the price of $29.50. Where is $29.50 coming from? Remember, that's the strike of the calls that we sold. So on the expiration date, we want it to be as close to that strike as possible. If it can be on that strike exactly, but again, the probability of that happening isn't too high, but we want it to be as close to that as possible. So that's why we start by determining what price we think the stock will be at on expiration date. And then we have our break-even points. We have a probability of profit, which is around 16.3%. Again, take this with a grain of salt. If we actually click on here, this is the probability of returning at least $1 at the time of expiration. Remember, you don't have to wait until expiration. You can close out before. This is also derived from 30-day implied volatility. So remember, stocks like Plug have been very volatile in the last couple of months. You know, they dropped 60, 70%. Now they're up, 30, 20% in the last month. So that's all going to be thrown off. And again, like I mentioned, Plug Power is probably not the best stock to use for this strategy, but here's just an example of what this would look like, right? And so here's the chart. Again, you don't have to wait until expiration. You can certainly close out, before. So for example, on the 24th, if Plug is around $30, I'd be up about $12, which is a 133% return. Now take a look here. On the expiration, if it's at $29.60, that's $81 profit. If it's at $29.50, that's a $91 profit, which is the most we can make. That's over a 1,000% return here if we land on this correctly. So again, very cheap strategy. Can give you some pretty big returns. Again, it's not going to have the highest probability of success, but as you get better, you can definitely make some profit with this strategy weekly. And so anyways, this is the variation to the long Christmas tree spread with calls here. Now, a couple of other things I do want to mention here, of course, like I mentioned, commission fees, right? We are opening and closing 6 contracts here. There's 3 here, 2 here, and 1 here. Now, Robinhood doesn't have any commission fees, so we don't have to worry about this, but there are some brokers that will charge you commission fees. And if you're opening and closing 6 contracts, that can add up to be a lot. So always make sure that you understand whether your broker has commission fees, how much that will eat away at your profit, and if this is still a desirable strategy to utilize after you've had to pay that commission fee. The other thing, of course, is the risk of early assignment. We are selling 3 call options here. Anytime you sell an option, there is risk of assignment. Being assigned early before the expiration date is rare, but it does happen. And it's generally going to be more related to dividends. So if you're doing this on a stock that has a dividend, that gives dividends, you should check for the ex-dividend date. If you're selling options that expire on the week on which that ex-dividend date lies on, you should avoid selling options that week. If you do sell options that week, you want to close those options 2 days prior to the ex-dividend date, or you're going to be early assigned, and it just ends up being a huge mess, guys. So anyways, this is the variation to the long Christmas tree spread. Now, if you have any questions, again, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.